Starbucks Corporation, ticker symbol SBUX, is having a fantastic year. It's up almost 17% in the last year to $102.50 a share. What I'm going to be doing today is taking it to my stock valuation spreadsheet, looking at discounted free cash flow models and the Ben Graham model to give the fair value of the stock. Is it a buy or a sell? So if we look at Starbucks, what's it been doing over the last year? Well, you can see it hit a pretty 52-week low at $70 a share and has gone up 45% since then. If we bring it back even further, this stock was on a tear since the pandemic. You could get it as low as $58 a share. It hit its all-time highs at about $125 a share. So does this stock have room to grow? Well, that is the question I'm going to answer right now. If I just look at the news quickly here, this is something that's very exciting. It's about to get easier to get Starbucks for delivery. They're already doing things with Uber Eats, but after successful testing with DoorDash in 2022, the companies announced a national partnership with 50 states in delivery by March of 23, and that is going to be happening this month. So very exciting, potential more growth for Starbucks once again. So let's have a look at my stock valuation spreadsheet. Let's enter in SBUX here, and we will go through the financials right now. Market cap 117 billion. A dividend of 2.06%, a very healthy dividend. People really like the stock for this, and a ex-dividend date of the 11th of May. So buy before then if you want the dividend. So firstly, we look at the PE ratio. Is it less than the market? And Starbucks has a bit of a high PE ratio right now, 35 compared to the market's 21. Next, we want to see if the revenue is increasing. And as you can see here, revenue has increased over the last 4 years, 26 billion to just shy of 33. And if we look at the years, 26 down to 23 in the pandemic, rebounded strongly, 29, and is now at 32, which is all-time high. So we want to see revenue increasing. But what's the profit done in that same time? Starbucks, unfortunately, it is a fail, 3.5 billion to 3.3. They got hit hard in the pandemic, almost just shy of $1 billion. Strong rebound year, 4.1, but is down to 3.2. So that is a fail. Next, we want to look at the shares outstanding. Are they increasing or decreasing? And yes, Starbucks are buying back their shares, 1.184 billion to 1.147 billion. Now, why is this important? Well, if there's 10 shares of a company, you own 1 share, you own 10%, they buy back 5 shares, you now own 20% of that company, and you have more share of those profits. Now, if we look at the share price, as you can see, it's been going up and down. So they have been buying back shares. To be honest, the stock has been a bit all over the place. So if they've been buying them back here at the bottom of the pandemic, that was a great investment here. Not so much in 21 to 22, but then it dipped down again. So this stock has been on a bit of a roller coaster. It's evened out. You don't like to see the stock price shooting up when they're buying back shares, because obviously it's a bit overvalued then. But Starbucks, it's been a pretty good decision for them overall, I would say. The free cash flow, is it increasing? No, it's not. 3.2 billion to 2.5. And once again, they had a down year in the pandemic year with only 114 million compared to 2.5. So we would like to see this increasing. They did increase in the previous year, but it's dropped down since then. So let's have a look overall. What does that give us? Well, it has a very high free cash flow ratio of about 46. I don't think discounted free cash flow model is going to like the stock. And yes, you can see straight away that it doesn't care for it. Fair value of $41 a share. Now, if we look at the numbers here, you can see that 2022, the number is down quite a bit. So we'll look and see if we can see. Yeah, so this is one of the problems right here. The net income margins are quite low. Once again, the pandemic year cost it quite a bit. So we'll take the averages of these. That is 12.7. So we'll add that in there. Now this puts the stock up to a $50 stock. If we look at revenue, see 8% here, but analysts are expecting 9 and 11%. So we'll go a bit on the bull case. We'll go to that 12. Now $53 stock. And finally, the free cash flow to net income margins. 2019 or the 2020 was a bad year for it. I'm going to update these actually right now because it's been annoying me to not change this. 2021, 2022, 2023, and 2024. So the pandemic year, it had a much lower net income to free cash flow ratio, averaged at about 91, and this brings the stock up to still $70 a share. But you look at these free cash flow estimates, it looks a lot more fair as long as they can keep growing their free cash flow. Next, we'll look at the Graham's model. This takes in earnings per share, PE growth, the growth of the company versus the bond yield, and we'll quick have a look at what analysts are saying for Starbucks. We'll look at the 5-year growth, and they're expecting around 18.02% over the next 5 years. And as you saw in the Ben Graham formula, that calculates the fair value at around about $120 a share. The Graham price, which is sort of a margin of safety buy and hold level, is 90. So we're not a million miles off that. I mean, it was $90 a share just a few months ago. So the model is actually saying it's a buy. Discounted free cash flow says the stock is overvalued, but in terms of growth, which is what the Ben Graham formula uses, it does think the stock is a buy. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it, and I'll catch you guys next time.